Good afternoon, everyone, and welcome to another fabulous edition of I-10 Second Thursday at Venture Cafe Virtual. We do programming here on the second Thursday of every month, ever since Venture Cafe opened in the fall of 2014. And we're actually doing one on the third Thursday because we're that crazy this month. So we'll have another event next week, but this week we're talking about equity. So I'll let Connie introduce our speaker, and thank you everyone for attending, and we'll see you next week and next month.
So I'm Connie Gallagher. I'm the Business Development Manager at I-10, and I'm happy to introduce our host today, Mark Grafficanini, and he is the Managing Partner of Stone. Stone's a national law firm focused on transitional law, securities, and corporate financing. And since leaving Silicon Valley and returning to his hometown of New Orleans to find Stone, Mark has successfully advised clients through various rounds of financing, exits, corporate governance, and fundraising strategy. And then over the last 10 years, Mark has led hundreds of financing transactions from seed rounds to IPOs, and the companies Stone has worked with have returned over $600 million to investors. In addition to his role at Stone, Mark is also a partner in Calais Capital Ventures, a Series A venture capital firm where he is responsible for sourcing, screening, conducting diligence, negotiating, and advising portfolio company management. So we welcome Mark. And Mark, I'm going to just turn it over to you and you can take it away.
All right. Thank you. Hello, everybody. I see some familiar names and I wish I could be there in person to see everybody at Venture Cafe, but I'm glad that you joined. And I know that based on the people that I see that are here attending today, I should get some good questions to stump me. So I'm looking forward to some good dialogue. And today we're talking about what is the better deal, convertible note or safe versus equity round. And I think that this has become a real issue of discussion among people in the venture capital industry, mentors at accelerators, founders. And I'd like to give you a little bit of my perspective, which might be somewhat different than the conventional perspective that you hear on this stuff. And as Connie mentioned, I basically got started in venture capital in around 2004 or so. And I had gone to college in California. I had started a law and business journal focused on nanotechnology with a bunch of people in Silicon Valley. I ended up practicing at the largest law firm out there, a firm called Wilson Sonsini, where I did everything from early venture and angel pre-seed deals through the IPO public company representation process. And then as everyone mentioned, I moved back home to New Orleans primarily about 10 years ago, and I started doing this under a firm that I created. And since then, we've become one of the more active groups, I think, in the space in the central U.S. So we've done hundreds of deals, over $1 billion of venture and angel capital transactions in that time, and it's actually been about $1 billion plus in exits. So in 2018, for example, I took a company called Waiter Public, which is a mobile food delivery app based in the Southeast. That was one of the largest non-Silicon Valley tech transaction IPOs that year. It's my fundamental belief that the future of innovation and really good exits belongs to places outside of the East and West Coast. And I think that there's a lot of exciting things that are happening in these markets. And one of my passions in life is helping to put some data and metrics around what's going on in these other markets, because a lot of what people read in blogs and a lot of the information they access sometimes concerns what's happening in places that aren't necessarily applicable in other markets. And as mentioned, one of the more fun things that's happened in the last year is that I've been company side primarily through most of my career, helping companies navigate the issues with venture capital financings. And now I've been fortunate enough to join a fund where we're investing $1 to $2 million checks in Series A deals. And typically we're looking at companies that are doing $1 million or more in annual recurring revenue. And I get to have a different perspective that's also informed kind of my thoughts about these different things. And so, the topic today, as I mentioned, are really our convertible instruments, things like convertible notes or safes, simple agreements for future equity. Are those things good or bad? And the answer to that question, like most things in life, is it kind of depends. But I'll tell you some things that I've found throughout my career. So the number one reason that people cite to me when they're starting a fundraising especially at an early stage level, like a seed or pre-seed level, is people say, well, I want to do a convertible note or a SAFE because, we're just going to grow so much between now and the time I do my Series A. It's impossible to peg a valuation at this point, and I don't want to harm myself by putting it too low and doing an equity round. And I'll say that this is really a new development, relatively speaking, in the history of venture capital. So like I said, I've been doing this for almost 15 years now. And historically, notes and safes were primarily used for bridge rounds, meaning like a round between a Series A and a Series B. So typically, especially in Silicon Valley when I was there, I would see a safe, or really safes weren't even done when I was there primarily, but convertible notes were typically used after a company had done a Series A and something went really well or something didn't go quite as planned. So they could be used to get a company out of trouble if it didn't hit its milestones. And the idea was that you gave something to an investor that's better than equity, that's an inducement to come in the round between that period of time, because it's a little bit more risky than maybe it was in the equity round. Conversely, if something really positive happened, like the startup got a really big customer and they needed to scale up their expenses and hiring needs and other things, then people would do a convertible note in order to get to that next milestone and then do a B at a really outsized valuation, or you could say B to C or whatever it was at the time. As the recession took place in the last recession, so from 2008 to 2009 or 10, you started seeing a lot of people get into early stage financings that weren't really there before. So one of the benefits, I think, of the last recession is that whereas most investments that I was doing on the West Coast involved established venture capital groups and some super angels, so really super high net worth individual people who were writing multiple $1 million plus checks per year, you started to see a lot of different angel groups pop up, whether they're angel networks or funds or individual angels. You saw across America an attempt to boost up mainstream to places like St. Louis and New Orleans and Tennessee, et cetera. We're really focused on building the local communities and supporting entrepreneurs and local networks. And you started to see kind of a proliferation of convertible notes. Then, if you're not aware, a group in Silicon Valley called Y Combinator, which is really in the business of incubating companies and providing a bridge between some investors and early stage companies, came out with this instrument called the Simple Agreement for Future Equity. Now, the term that I did not see a whole lot before the last recession that I started seeing after the last recession is something called a valuation cap, which is what we'll get into in the next slide. But I give some of that context and history because, again, I think when it's important as people think about what to do for their first round or their second round, and as they're evaluating their financing strategy, that they understand some of the historical context, because notes and safes really weren't typically used to minimize the valuation risk to the founder. In fact, they were used to do the opposite. They were used to incentivize in a difficult time investors to come into deals and say, look, you're going to get the benefit of interest and you have no risk that the valuation is going to be higher than what you would have negotiated with me anyway. So instead of actually being a favor to founders, really, I believe notes with convertible, with valuation caps and safes, which always have valuation caps for the most part, were done as a favor to investors to induce investment by people not that familiar with the whole concept of early stage investing. And so, but nonetheless, these have taken root and they're a fundamental feature now of the early stage company landscape. So when you think about these instruments, you want to keep this in mind. And the reality is a note or a safe is not always the best deal for a company. So it's important that as you're doing these things, you want to actually do the math and model out what the conversion of this instrument is going to be in your next round. So a couple of factors to consider here. Number one, I would say that in general, if you don't know, you should know that what an investor typically buys in any given equity round is on the low end 10% of the company, and on the high end typically 33 or so percent of the company. So most investors don't want to go higher than 33%. They don't want to end up with a 40% stake in a company. They don't want investors as a block to do that. When later investors see that, they often think, well, there's something wrong with the cap table. People already own too much of the company. The founder might not be incentivized to see this through. So that's kind of a background thing to consider. So whenever you're doing a note financing round, it's important, or a safe, it's important that the money under that instrument that's planning to convert, that plus the new money is supposed to equal 10 to 33% of the whole company at that Series A. If you end up selling 40% or higher because of the conversion and the valuation caps plus the new money, people are going to look twice at your capital structure and think that there's a problem. And again, you shouldn't necessarily look at a convertible note or a safe as a financing round in and of itself. It must be looked at, because it is the nature of the instrument, as a part of a Series A. And so it's important that you understand what's a realistic valuation conversion price at the time these notes converts in order to do the calculations here. So I take it for granted here that most of the notes that I see out there in the market, of course, not for our clients, we don't typically agree to them if we can get away with it, but I see a lot of companies out there, especially as an investor, that have agreed with early stage investors to a very low valuation cap, or a valuation cap of any kind. And what I want you to consider here is that a valuation cap can and will be used against you in a negotiation for your Series A. So there's almost no investor that will look at a company at a seed stage 2 or a Series A that isn't going to look at your current instruments, your convertible notes and your safes, and they're going to look at your valuation cap and they're going to say, well, I assume that you had good advisors. I assume that you did the math and you anticipated your valuation being this number at the time you're soliciting a group like mine for investment. As an investor, I do it to people. When I'm advocating for a company, I see it done to clients all the time if they have a valuation cap in place. So one of the big reasons that people often cite for doing a note round in the first place to escape the valuation question, what I'm telling you is, if you have a valuation cap in your note, it's unlikely that that's going to happen. Instead, it will be used as a basis or a starting point for a negotiation. I think the second thing to consider and to think about is that the expectation is that your valuation cap, to protect yourself, it really has to be at a minimum equal to what your valuation is going to be in the next round, or it should be higher than what you think is reasonable. In other words, put a reach in there. Otherwise, it only works to you as a founder to your disadvantage. So why is that? Well, with a note, you're giving an investor interest. So they're already getting compensated for their money being in the form of interest, which then converts into equity later. So their money goes further automatically already. If you set a low valuation cap, it means there's absolutely no risk to the investor that their valuation is any different than yours. So it creates a little bit of a misalignment in interest. Whereas if your investors are uncapped, they still get a discount to the price per share paid in the next round. So they still get a better value for coming in early, but you might be able to convince them that a higher valuation negotiation is still in everybody's interest and that you're still aligned. The second thing that I think a lot of people don't understand is that there's something called a valuation overhang. And to understand this concept, you essentially need to understand how an equity financing works. So I think it's a mistake when founders go, I'm not going to worry about how equity financing works right now. I'm just going to worry about this note. It's way easier, because you're missing a couple of key points. So if you're familiar with a convertible note instrument or a safe, you're familiar with this concept of a discount price. And that's the 80%, let's say, that the note converts into of the price per share in the next round. So if you're selling shares in the next round for $1, your note investor is going to get an 80-cent per share price. Well, the way that equity documents are typically worded is that you're selling one kind of preferred stock to investors in the next round. So let's say you're selling Series A preferred stock to the investors in the next round for $1 per share. That's the new investors. Your old investors then get the same number of shares at 80 cents. So they get more shares, but then on top of that, the way that the liquidation preference, that's the money that the investor gets out of the company if you exit, is all tied to that price per share of the new money for the most part. So in other words, every investor, whether they paid 80 cents per share or they paid $1 a share, is going to get the same $1 back when the company exits. Now, you can have a lawyer negotiate what's called a shadow series of preferred stock. That would say, if you paid 80 cents per share, you get 80 cents at the exit. If you paid $1, you get $1 per share at the exit. but it starts to make your capital structure look a little bit messy. So in order to do that, you'd have to have a series A1 and a series A2. And one group gets the A1, one gets the A2. It's not that big of a deal, but it does start to make it look a little bit messy. And sometimes when you start seeing companies sell shares at different prices to different groups of investors, it makes an investor scratch their head and go, what's up with this? Either they didn't adequately determine how much money they needed, so they had to sell different things at different prices, or it just raises a red flag. I got to stick lawyers on this, or I got to stick people on my analyst team to go do diligence why this is happening. So although you can compensate for it at your Series A, it has to be negotiated, which isn't going to be a big thing that your note or safe investors want to do, and it gets a little bit messy. So even if you do compensate for the valuation overhang, it leads to a little bit of an issue before. And I would encourage you again, the idea about a valuation cap was there because people in the last recession primarily were concerned that the recession had led to a dip in valuations, which it has again this time, and that they didn't want to have a big problem in those bridge rounds for when things corrected and some of those portfolio companies were doing the next round. So again, the genesis of this was not company favorable. And if you're putting a valuation cap in your note, then you really ought to consider whether or not it makes more sense to do an equity round if your valuation cap is equal to or lower than your expected valuation in the next round. Another thing that people often overlook is you know, if as a VC, I were to go to a bunch of companies and do an equity deal, and I said, you know, at a minimum, I get 2x my investment, then that would be what's called, you know, a liquidation preference multiple. And what people oftentimes fail to realize is that a lot of convertible note deals and safe deals have what's called a change of control premium. And so what that is it's a guaranteed multiple on the investment of the investor in that deal. So a common one is anywhere from 1.5x to 2x the investment. So many investors negotiate in the context of a note that they'll get paid at least either a lot of times they'll say, I get the better deal of either 2 times my investment or whatever the valuation cap is, or, you know, a discount, and they get to elect among those things. Well, it's very rare in any equity deal these days that investors get a liquidation preference multiple. So in other words, you know, only in very rare cases, I would say, where you're doing a Series B or C and there's some trouble with the company or maybe the economy, where investors are able to negotiate more than a 1x multiple. So most equity deals, and for example, if you did a Series C deal, then you would be agreeing with investors typically that they either get their money back or they get their pro rata share. So they get what's called a non-participating liquidation preference. So oftentimes on that change of control premium, it's not a better deal. In other cases, you know, you're still giving the note investors and safe investors a lot of times basically a veto right. If you don't give them a change of control right, you're essentially giving them a veto right over a transaction like that where they would get, where the company would get bought out or something. So that's another factor to consider where an equity deal might be actually better than your convertible note or safe deal. Another site that I get, or another argument in favor of a convertible note round is, or a safe round, is oftentimes that it costs less. And I'm here to tell you that if you're using a lawyer that says that a convertible